How do you find good mutual funds in your 401k? And what do you do if your 401k doesn't offer the mutual funds you want to invest in? And who is Carl, and what's so great about his mortgage calculator? We'll answer these questions and more on this, the 43rd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, welcome to the 43rd episode of the DoughRoller Podcast. I think I'm fighting something a little bit. I don't know if you can hear it in my voice, so you'll forgive me as I sip some tea as I go through this podcast today. I think I'm slowly losing my voice. But I'm trying to hang in there. Got a great show for you today. I hope you find it useful. We're going to be talking about a number of different tools that makes it, I think, as easy as possible for you to find some great mutual funds, hopefully, in your 401k. It's a tough issue because, unlike an IRA where you can open them up pretty much wherever you want, at a broker, at a mutual fund company, at a place like Betterment, with your 401k, you're stuck with whatever your employer decides to put in the plan. And in some cases, you've only got a few options. And in other cases, you may have, dozens, but you're scratching your head thinking, well, I don't understand which ones to pick. And some of them, are very expensive and none of them look all that great. What do I do? So I'm going to give you some thoughts on that and some tools to use. Before we get to that, though, let's talk about the tool of the day, and it's Carl's mortgage calculator. And I know, the first question, who the heck is Carl? I have absolutely no idea. Actually, I've emailed Carl from time to time. I thought his mortgage calculator was so great. I actually wanted to buy it. I was in this sort of, I want to own a website that has calculators, and I thought his was great, so I emailed him, and he was very nice, but said, no, I'm quite fond of my mortgage calculator. He didn't want to sell it, but it's a great calculator. And it's unlike sort of, if you just type in fact, I'm going to do this right now. If you go to Google and you type in, I don't know, best mortgage calculator, I don't even know if his comes up on the first page. Let's see. You get one from, mortgagecalculator.org and CNN and Dave Ramsey. I guess he's got a calculator. Zillow. He's not even on the first. Oh, here he is. He is on my search. He is on the first page. Got to make sure it's off of what's called personal search. Yeah, there he is. Carl's Mortgage Calculator. The URL is actually drcalculator.com/mortgage. And by the way, I have no idea why it's DR Calculator. That's not DoughRoller. I've got nothing to do with this calculator. drcalculator.com/mortgage, or you could just search for Carl. It's with a K, Carl's Mortgage Calculator. And you're saying, okay, Rob, that's fine, but there's a ton of mortgage calculators out there. Why is this one so great? Well, first thing is, when you go to it, it looks like a calculator. Well, it was built in the 90s. It's not as flashy as some of the mortgage calculators you find today. But the thing I like about this calculator is two things. One, it's very easy to use. And two, it has a ton of options. This isn't a calculator where, you just stick in the amount you're going to borrow and the interest rate and maybe your insurance and taxes, and it generates your monthly payment. It'll do that, of course. It'll generate an amortization table to show you how your balance will come down over time. And that's fine. You'd expect that. But one of the things it does that I found very useful is it allows you to figure out how paying extra on your mortgage will reduce your balance and how quickly you'll be able to pay it off and how much interest it will save you. When you look at the calculator towards the bottom, you'll see a row of buttons. The buttons are expenses, prepayment, extra interest, and ARM, adjustable rate mortgage. And when you click on any one of these, it brings up more options. And the prepayment option is the one that's really of interest to me, particularly as my wife and I think about paying down our mortgage. And it's got a number of options. For example, let's say you're in a 30-year mortgage and you've paid through five years, and you think, well, now I want to start paying $50 a month extra or whatever. Well, you can actually put that prepayment in there on a monthly basis, 50, and the starting month. So in your case, you've been through 5 years, so that's 60 months. So maybe your starting month is 61. Well, you can put that in there, and it will calculate how that will affect your interest going forward, how it will reduce your principal. It gives you a graph to show you. And then you can start playing with it. You say, well, what if I put in $75 extra a month? and that sort of thing. And the other thing you can do is sometimes people don't want to pay a little extra a month, but they want to every now and again sort of make a one-time prepayment. One month just pay an extra $1,000 on their mortgage or whatever. Well, it's got that too. You can put that in there, and the month that you're going to make that one-time prepayment, and that will also show you how it will shorten the term of your loan, the interest it'll save you. It's a really great mortgage calculator. Of course, it's totally free. And if you just happen to be listening to this podcast, and I doubt you are, but if you are, hat tips to you. That was kudos to you, I guess I should say. That's a great calculator. And if you use it, if anyone listening uses the calculator, shoot me an email. Let me know what you think of it. But for my money, it's one of the best mortgage calculators out there. The best one out there, and I've looked at a ton of them. And so give it a try. Let me know what you think. Okay. On to 401k. So here's the problem, and I encountered this early in my investing, early in my time investing. I would read a lot of books. A couple of my favorites are Rick Ferry's All About Asset Allocation. There's also 4 Pillars of Investing, which is a great book. And they'll mention mutual funds and asset allocation. I really got enamored with Vanguard, as loyal listeners know. And so I kind of map out my asset allocation, how much in stocks, how much in bonds, domestic, foreign, and the Vanguard funds that I wanted. And then I'd head on over to my 401k, and of course, none of those funds were in my 401k. Not a single one of them. It's like, what do I do now? And to make matters worse, I would look at this list of mutual funds, and I was like, I don't know how to begin to decide, what I should pick. When I was reading the book, it seemed so easy. Rick Ferry makes it easy, and in some ways it is. But then when you want to apply it and you're in your 401k, it's like, Rick, help! They don't have the funds you were talking about. What do I do? And you may be reading the book and you may already know that your 401k doesn't have the funds that you'd like to buy, maybe that are mentioned in the book. And I mentioned Vanguard, but whatever. Maybe you want to buy a Fidelity fund or a T. Rowe Price or whatever, and your 401k doesn't have it. So what do you do? That's what we're going to answer today, and I'm going to give you some tools to help you get an answer to that question. So let's first talk about how I think many people pick a mutual fund. And I think, I'll be curious, email me if this is you. And I'll confess that I am not above this, and particularly early on, I would do this. You go into your 401k, you look at the funds, and what do they show you? They show you the performance. 1-year performance, 3-year, 5-year, 10-year, maybe since inception, since the mutual fund was started. And you start comparing. They're side by side. And I mean, why not pick the one that's got the highest performance? I mean, why would you pick one that's got the lower performance? So you pick the mutual fund based on past performance. I know you do it. I've talked to so many people, and I did it myself. And it was like, what else do we have to go on? I mean, and that's easy. And again, why in the world would you pick a fund that seems to have underperformed in the past? Well, the problem with that, of course, there's a couple of problems with that. One is, as we've said, just because it performed in the past one way doesn't mean it's going to continue to perform in the future. The problem with that, though, is, but still, why would I pick the lower performing fund? You're right, they might not perform the same way in the future, but how does that get me to pick something other than the best performing fund? And that gets me to really how you should pick a mutual fund. And we've talked about this in depth. If you go through the 31-Day Money Challenge, which I recorded in January, when you get to, let's see, it's about podcast, let's see, it's a DR29. So if you go to DoughRoller.net /podcast 29, let's see, that's not quite right. Let me get this right. It's 24. It starts at 24. I'm sorry. I'm looking at my list of podcasts. DoughRoller.net /podcast 24. That's where I begin to talk about investing. We walk through why you should invest like you're buying a whole business. I walk through asset allocation, how to pick a fund, why fees matter. I tell you my investment portfolio and my asset allocation. So I'll go through that in detail. So you can check that out beginning with podcast 24. So it's DoughRoller.net /podcast 24. For today, though, let's talk about real quickly the 3 things you should focus on when picking a mutual fund, right? The first is the asset class. So you should have an asset allocation plan, right? How much you're going to have in stocks versus bonds, how much you're going to invest in U.S. stocks versus foreign stocks, right? And so once you have that plan and you're going into your 401k to pick mutual funds, you want to make sure you're buying funds in the right asset classes. So if you're going to have, for example, let's pick a number, 50% of your investments in U.S. stock mutual funds, then you want to make sure that you find a mutual fund that invests in U.S. stocks and that you have 50%, if that's your plan, 50% of your money in that fund. And it could be more than one fund for that asset class, but however many it is, you want to make sure they're in the right asset class. So that's the first thing you should focus on. The second thing, of course, is cost. You always want to look at the expense ratios. That's why I favor index funds, because they're so inexpensive. My goal is to have the total cost of all of my investments at under 25 basis points. That's just 1/4 of 1%. So cost you need to check out. And all of this information is available to you when you log into your 401k. And then the other thing I want to look at is the investing style of the fund. And primarily what I mean by that is, again, this goes back to what we talked about with cost. Is it an index fund or is it actively managed? Now, I generally favor index funds, again, because they're inexpensive and because I think most actively managed funds won't beat the market over the long term. However, I do have some actively managed funds, and we're going to even talk about one today. But when you're picking a fund, I think it's important to understand, is this an index fund or is it an actively managed fund? And if it is an actively managed fund, how do they pick their investments? And again, all of that should be available to you in your 401k. Now, I kind of go through that because, we're going to talk about some tools that make this easy, but I don't think we should ever use a tool without understanding how it works. And the tools we're going to look at, there's one free and there's one paid. They're both from Morningstar. They look at these things in comparing mutual funds. They look at cost. They look at asset class. They do look at performance. That's not irrelevant. It's just certainly not the only thing that we should look at. But I think it's important that you understand how these things work rather than just sort of blindly using an online tool to make a decision as important as how you're going to invest your money. And in fact, you don't need these tools. You could do it the old-fashioned way. You could, for example, if you were wanting a Vanguard S&P 500 index fund, but your 401k didn't offer Vanguard, you could dig into the funds that they offer, look at the asset class, look at the cost, see which ones are indexed versus actively managed, see if any of them track the S&P 500 index, and if you find one, then you've found what you're looking for. It may not be a Vanguard S&P 500 index. In fact, at my 401k, I have a Fidelity S&P 500 index fund. It's only 4 basis points. That's really cheap, and it works fine. Of course, then the problem comes, well, what if your 401k doesn't have an S&P 500 index fund? All of their funds are actively managed, for example, and then things get a little more complicated. And that's where these tools can come in handy. So let's get right to them. The first one is called the Morningstar Compare Tool. It's free. I'll have a link in the show notes, of course. And how it works is it's very simple. You simply put the ticker symbols of the funds you want into a box. And again, I'll have a link to this screen. And I'm going to compare 2 funds. The first is VDMIX. VDMIX. I picked this fund on purpose because it's a little more difficult than, say, an S&P 500 index fund. It's a little more difficult to find comparable funds, and that's the Vanguard Developed Markets Index Fund. It's an investor share. So this will be foreign investing in companies in overseas, not in the U.S. It is an index fund. And so it's VDMIX. So I put that ticker symbol in, and I'm going to compare it to a fund that is available in my 401k, and it's the Dodge & Cox International Fund. It's DODFX. And I thought it was an interesting comparison because VDMIX is an index fund. DODFX, the Dodge & Cox fund, is not. It's actively managed. So in some ways, I'm comparing certainly two different investing styles, but they are both funds that invest in international companies. So in that sense, they're the same. So let's set the scenario. Maybe you've done your research, read books. Hey, listen to my podcast, maybe, right? We're here, right? So, and you really like that Vanguard Developed Market Index Fund, but it's not available in your mutual, in your 401k. But and again, hypothetically here, the Dodge & Cox fund is. And so you think, well, I might invest in the Dodge & Cox fund. That looks pretty good. But let's compare the two and see what we get. So you can put those tickers into the box there on Morningstar. Again, I'll have the URL in the show notes. And then you can compare them. And it gives you a number of ways to compare them. When you first hit the compare results, it gives you just a snapshot. It shows you that they're both foreign large blend. So real quick, foreign, they invest in foreign companies. Large, they're large cap companies, companies with a large market capitalization, which would be simply the number of their shares times the value, the market price of the share. And they're blend funds, which again means they're sort of a blend between what are considered value stocks and growth stocks. Again, I cover some of this in the 31-Day Money Challenge, so you can check that out if you want. It gives you the Morningstar star ratings for each of these funds. Dodge & Cox is a 4-star. Vanguard Developed Markets is a 3-star. I don't put a whole lot of weight in the star ratings. Most index funds are 3 stars because they just track the index, but it's there for you to look at. Gives you the year-to-date return. Actually, the Dodge & Cox is beating the Vanguard Fund this year so far. Dodge & Cox, 2.09%. Vanguard Fund is 0.78%. And then the expense ratio. Now, remember, costs are critical. Dodge & Cox is 64 basis points. That's not, by actively managed fund standards, that's quite good, actually, 64 basis points. But by index fund standards, not so good. And you see that here. The Vanguard Developed Market Fund is just 20 basis points. So Dodge & Cox is more expensive. That's something to think about. And then you can change the view. There's a little drop-down box. For example, you can look at performance. It shows you the performance out 5 years. I won't go through all the numbers, but there they are. You can compare the performance. Then you can get into risk and tax data. This is pretty important. They show you the standard deviation, and that's probably a whole other podcast if you're not familiar how standard deviation is used to assess the volatility or risk of a fund. But I'll just for today's purposes, the higher the standard deviation, the more volatility you can expect for a mutual fund or a stock or any investment. And they're roughly the same. Dodge & Cox is a little higher, 17.91. The Vanguard Developed Market Index Fund is 16.96. That means that you can expect a little more volatility from the Dodge & Cox International Fund. It's not a huge difference, but there's a little difference. And you can see tax information. In my case, this is in a 401k, so that doesn't much matter, but they're quite comparable. And then you can also then look at the portfolio, and that's another tab. This is an important one. In fact, I'd say probably one of the most important ones here other than cost. It shows you the style box, which we already know these are large blend funds, but it shows you the PE ratio, the price to earnings ratio. Again, I kind of view the PE as the higher the PE, the more expensive the fund is relative to the earnings that the companies in the fund are generating. And Dodge & Cox is a little pricier. It's 16.69 is their PE versus Vanguard is 15.11. And it shows you other information. It shows you the average market cap. Dodge & Cox is although they're both large blend companies, Dodge & Cox is a bit larger, $43 billion average market cap versus $32 billion for the Vanguard fund. It shows you their yield right on dividends. Vanguard Developed Market Fund yields a bit more, 2.56, which is a pretty nice yield. Dodge & Cox is 1.59. And so you can go through, and there's more data here. It gives you what they call the nuts and bolts, the things like, again, the expense ratio, whether there are any front loads for the fund or back-end loads. There aren't for any of these. And things like that. It shows you the minimum initial purchase requirement, although, again, when you're dealing with 401k, that's usually not relevant. And so anyway, that is the Morningstar Compare Tool. It's free. I encourage you to check it out if you're trying to analyze and look at funds in your 401k that might work for you in your investment plan. So that's the first tool I want to talk about. Again, it's free. The second one is a little more sophisticated. It's called the Morningstar Find Similar Funds tool. And again, I'll leave a link in the show notes to this tool. And it works a little differently. Here, what you do is you put in the ticker of a mutual fund. Again, I've used the Vanguard Developed Markets Index Fund. And when you enter it and then hit go, their button, what it does is Morningstar goes out and it searches across all of its database and finds mutual funds that it thinks are comparable to this mutual fund. And it lists them for you. So you don't have to know the other fund. You don't have to put in 2 ticker symbols. You just put in one, and it lists all of the funds that it thinks are comparable. And in the case of the Vanguard Developed Market Index Investor Share Fund, it came up with 26 results, and it gives you a ton of information about each of these mutual funds. So in the first screen you'll see what's called a similarity score, and it's just a 0 to 10 scale on how similar the list of funds are to the one you've put in this case, Vanguard Developed Markets Fund. So it has an overall similarity score, performance similarity score, portfolio similarity score, and you can check those out. What you generally find with an index fund is that for those that are the most similar, there are also index funds typically that track the same index. And in fact, as I look through the list here, there are several funds that have a 10 for performance similarity, and that tells me that they track the same index and that their expense ratios are very comparable. And there's a number of funds here that, while not a 10 on the performance similarity score, are very close, 9.99, 9.84. There's a number of them. If you run this search yourself, you'll see them. And one of the things I like about this tool is that you can quickly look through all of these funds. So I'm looking at it now. They have funds from Fidelity, Dreyfus, BlackRock, Northern, Nationwide, State Farm, Schwab. And so, hopefully you can find a fund in this list that's in your 401k. Now, of course, that's not always going to be the case, but hopefully you can. And what you can do then, once you do, is go through, I mentioned the similarity scores, but they also give you an overview, the category they're in, the star rating. There's a tab for performance. All of the tabs we looked at in the compare tool, really. There's a tab for risks, gives you standard deviation, alpha, beta, the Sharpe ratio, things that I won't go into today that may or may not be familiar to you. Maybe that's a future podcast. Also gives you information on expenses. And that you can almost just look at the expenses and tell which funds are index funds. Those that are around 20 basis points, index funds. But I'm looking at some funds here that charge 1.67%. That's not an index fund. Here's the other neat thing you can do with this tool. Let's say you find some funds that you do have available to you in the 401k. Well, you can put a little check mark. There's a box next to each of the funds listed here. You can put a little check mark next to the Vanguard Developed Market Index Fund and then the funds that are in your 401k. In my case, I checked 3 Fidelity funds because that's who manages my employer's 401k. And then once you do that, you can actually move those tickers over to the fund compare tool that we just looked at a few minutes ago. And it automatically inserts all of the funds that you've checked into the compare tool where you can look at just those funds rather than looking at a long list of 20, 30, 40 funds. You can just look at the ones that are relevant and important to you. It sort of narrows it down. Then you can go through all of the things we just talked about on the Morningstar compare tool. So I hope you find these tools helpful. I think they're a great way to make the research of funds easier. It'll show you funds that you on your own you'd never find. And particularly in the context of a 401k where you have some limited options, it can be a great way to research those choices and to compare them to perhaps funds you'd like to buy, like a Vanguard fund, for example, but that perhaps is not available to you in your 401k. If you use the tools, shoot me an email. Let me know what you think. If you find them helpful, if you can sign up for Morningstar. You can just go to DoughRoller.net/Morningstar, and that will redirect you to the Morningstar page where you can sign up. They have a free membership that gets you access to some tools, including the compare tool, as well as the ability to input a portfolio into Morningstar and track your results. They do have a premium membership. That's what I have. You'll need that if you want to use the Morningstar Find Similar Funds tool. That's only for premium members. But I'll tell you what, Morningstar, even for the free membership, a ton of information, research, data. It's an excellent source for evaluating mutual funds. Okay, that brings us to the money tip of the day. Here it is. The latte factor is not really about the latte. So I've been reading a lot of criticisms of the latte factor. If you're not familiar, the latte factor was introduced by David Bach, who wrote a book, The Latte Factor. And the idea was this. If instead of getting the latte, your daily latte at Starbucks that costs you whatever, $4, let's say, a friend of mine calls Starbucks $4. So there you go. Instead of going to $4 for a latte every day, you took that money and invested it, you'd have a pile of money in 10, 20, 30, 40 years. And the point was, it's not hard to save a lot of money. It doesn't take massive changes in your life to end up saving a lot of money. Well, the latte factors come under a lot of criticism. I've read a lot of stories lately about people saying, "Oh, come on, it's ridiculous. If you want to enjoy, if a latte makes you happy, get a latte. Life is too short," right? You hear that. Life is too short. You need to enjoy life. And of course, that's true. There's balance, right? We want balance in everything, I think. But my tip of the day is this. I don't think the latte factor is really about the latte, right? If you like a latte and you want to go to Starbucks every day, go to Starbucks. That's your choice, right? It's a choice I make, not every day, but several times a week. The thing to take away from the latte factor is that saving small amounts of money over a long period of time can have a huge impact on your finances. That may not mean that you avoid Starbucks, right? It may mean that you cut back in some other areas. I mean, for example, we got rid of our cable boxes, our digital video recorders, and it was tough. The first week was hard, but you know what? After about a week, I don't miss them at all, and I save $50 a month. And here's, to me, the real key with the latte factor, and it's this. We need to understand what makes us happy, what makes us content, and what doesn't. And I think, and I'm speaking for myself, we spend money in ways almost mindlessly that don't really add to our enjoyment of life. And there have been times, for example, when I've not gone to Starbucks at all for months, usually because of the calories as much as the money. And you know what? My life was just as good as it is when I go. It wasn't as if I was unhappy or it was difficult. You say, well, why do you go now? Well, that's a good question, I guess, because I'm as imperfect as anybody. But I found that we spend money. I spend money mindlessly. Sometimes it's just out of habit. You go to Starbucks because that's what you do in the morning. Or you have a digital video recorder because doesn't everyone have one and they're kind of convenient and there they are. Now, in your case, it may be something totally different than what it is for me and for my family. But I found that when we really think about the way we're spending small amounts of money, I find that I spend money in ways that don't really add meaningfully to my life. Oftentimes, again, it's just out of habit or convenience. And if you can really try to think intentionally about how you're spending money, you'll find ways that you can cut back, one, that don't affect your life in any meaningful way, and that over the long term can have a big impact on your finances. And to me, that's really what's at the heart of the latte factor. It's not the latte. Well, there you go. That brings us to the end of today's show. You can find the show notes. Just go to DoughRoller.net/podcast43. And as always, you can email me, dr@DoughRoller.net. I read every email. I respond to every email. And with that, remember, the best thing money can buy is not a latte. It's financial freedom.